Welcome back to LAUSEC Open and Distance Learning Lecture Series on ACT 110 Introduction to Business 2, Study Section 4 Functional Areas of Business, Finance and Accounting. In the previous study section, you learned that functional areas are teams of employees who have similar skills. And accounting is the process of recording, classifying, reporting, and analyzing money. At the end of this study section, you should be able to describe the concepts and role of accounting in business. You should be able to differentiate between cash and accrual accounting. You should be able to explain the rules related to double entry and also to examine the components of accounting system. Let's discuss this learning outcome one after the other. Role of finance. Accounting can be described as an information system that provides reports to stakeholders about the economic activities and conditions of a business. So, the responsibility of the finance and accounting functional area within an organization includes 1. Facilitating operation, and this includes the payroll, the purchasing, the cash collections, the cash disbursements, and also management control. This is the measuring of actual performance against goals and expectations. Management decision making. This involves analyzing cash position to make decisions. And the next one is external financial reports. This deals with financial statements prepared according to general accepted accounting principles, the GAAP, and which is available for audit. And the last one is tax returns. This includes the federal and state income taxes. It might also be property, sales, or payroll taxes. The concept and role of finance and accounting in business. Accounting involves periodic reporting of financial data, which includes the following. The first one is business transaction, in which businesses keep a daily record of transactions in sales journals, cash receipt journals, or cash disbursement journals. And the next one is debit and credit to general ledger. This includes an up-to-date general ledger which shows current information about accounts payable, accounts receivable, owner's equity, and other accounts. And the next one is making adjustments to general ledger. General ledger adjustment lets businesses account for items that don't get recorded in a daily journals, such as bad debts, accrued interest or taxes, by adjusting entries. So businesses can match revenues with expenses within each accounting period. Closing the books. After all revenues and expenses are accounted for, any net profit gets is being posted into the owner's equity accounts. Preparing financial statements. This occurs at the end of a period where businesses prepare financial reports on income statements, on statements of capital, on balance sheets, cash flow statements, and other reports, in which summarizes all the financial activities for that period. Which summarizes all the financial activities for that period. Accounting terms and concepts. Accounting terms and concepts that a business manager must be familiar with in order to make setting up an accounting system easier for him or her are as follows: debit and credit. Accounting terms and concepts that a business manager must be familiar with in order to make setting up an accounting system easier are as follows: 1. Debit and credit. An understanding of debit and credit is essential in the effective usage of any accounting system, and every accounting entry in the general ledger contains both a debit and a credit. Further, all debits must be equal to all credits. If they don't, the double entry system is out of balance. And the next one is assets and liabilities. Assets and liabilities involve the balance sheet accounts. Balance sheet accounts are the assets and liabilities for a firm. Identifying assets. An asset is any item of value owned by a business. A firm's assets are listed on its balance sheet, where they are set off against its liability. And assets may include factories, land, inventories, vehicles, and other valuable items. Identifying liabilities. Liabilities are the opposite of assets, and these are the obligations of one company to another, in which accounts payables are liability, and it represents a company's future duty to pay a vendor. So, the loan taken from a bank is also a liability. So, a business organizes liability into a short-term and long-term categories on a balance sheet. Owner's equity. Owner's equity is the difference between assets and liability. It increases and decreases just like they do. Owner's equity includes factors like partners' capital accounts, stock and retained earnings, and also income and expenses. This follows after the owner's equity section according to chart of accounts. Income accounts. Income account. A business may want to establish an income account for different income generating departments of a business. In that way, it can identify exactly where the income is coming from, and the income of the various departments can be added together. And the last one is expenses account. Most companies have a separate account for each type of expenses they incur. A company probably incurs much the same expenses month after month. Thus, once they are established, the expense account will vary much from month to month. The functional areas of finance and accounting are as follows. We have public accounting, we have the auditing and general accounting. Under public accounting, it is useful in compilation and review services for tax preparation and planning. Under auditing, it is useful in audit, planning, and analytical procedures which include work paper preparation, study client internal control system, audit sales and collection cycle, accounts receivable. The functional areas of finance and accounting are as follows. We have public accounting, we have auditing and general accounting. Under public accounting, it is useful in compilation and review services It is useful in tax preparation and planning. And other auditing, it is useful in audit planning analytical procedure, which include work paper preparation. It also useful in study client internal control system. It also useful in audit sales and collection cycle, that is the accounts receivable. It also useful in audit sampling, that is the test of transaction. It's also useful in audit payroll, that is the cash balances, the inventory and purchasing review for contingent liabilities, subsequent events and completing the audit. And lastly, under general accounting, it is useful in preparing financial statements and management reports and analysis. And it's also useful to analyze financial statements under research stock and portfolio options. And it's also useful in preparing operating budgets, that is the capital budget and related forecasts, and conduct payroll analysis. It also it assists in cost control and performance measurement of decentralized operations and product costing activities. The following are the principal methods of keeping track of the money that flows in and out of a business, and it includes accrual accounting and cash accounting. Under accrual accounting, in an organization using this accrual method, an accountant records income and expenses when they are earned or incurred, and not when they are incurred, and not when they are actually received or paid. In practical terms, these differences in practical terms, these differences in timing is relevant if your company keeps inventory on hand or handles transactions on credit. And also cash accounting. If an accountant uses the cash method, he or she counts income when it is received and expenses when they are paid. Many small businesses, especially retail businesses, use the cash basis method of accounting, which is based on real-time cash flow. Double entry bookkeeping. Double entry requires 2 entries per transaction, which performs cross sections, cross checks and decreases error. Without a system to record or track the flow of money within a firm, a business cannot actually conduct its operating functions or make clear the operating decision. So in order to effectively operate, a business must ensure that the cash inflow from operating, financing and investing activities is in balance with the cash outflows that are associated with expenditure. In order to do this, accountants use a system of double entry. So accountants use a system of double entry in accounting to debit, that is to remove, or credit to add money as it flows into and out of their businesses. The components of accounting system are as follows: payroll accounting, accounts payable, fixed assets, inventory control, accounts receivable, other entry and cost accounting. Payroll accounting can be quite a challenge for the new business owner, and there are many federal and state laws that regulate what must be tracked related to payroll. So a business may face fines for maintaining incomplete or non-conforming records. So many business owners outsource their payroll services. By so doing, guarantee the compliance with all applicable laws. And the second component of accounting system is accounts payable, which represents the bills from suppliers for goods and services purchased on credit. Generally, these debits must be paid within 12 months, and it is important to track accounts payable in a timely manner in order to know how much supplier is owed and when payment is due. The next one is fixed assets. Fixed assets are commonly recognized as long-lived property owned by a firm that is used in the production of its income. So fixed assets includes the real estate, the facilities, and the equipment. And the next components of accounting system are good inventory control, in which it features in an essential part of a bookkeeping system. So if you're going to be manufacturing products, you have to track raw materials, work in progress, and finished goods, and separate sub-ledgers established for each of these inventory categories. Read more on this on your. Thank you for listening.